Hello and welcome to Growing Your Business by the Numbers, a three-part series. I'm Julie Cranston, Director of the SBDC at UCI Beal Applied Innovation, and I'd like to thank you so much for joining us today. Today's webinar is brought to you by the SBDC at UCI Beal Applied Innovation in partnership with Tgg Accounting. The SBDC is funded in part by the U.S. Small Business Administration in the state of California. The SBDC is here to help you start, grow, and succeed in your business by providing no-cost expert consulting and trainings such as this webinar. In addition to our regular consulting on business management and equity funding, we also have been helping our small business clients understand and apply for SBA loans like the Economic Injury Disaster Loan or EIDL program, and also the Paycheck Protection Program or PPP loan. We can also advise on how to administer these loans if you've received them, so make sure to reach out to us if you need assistance. We have a hotline set up and additional resources available. The hotline number is 1-800-616-7232. If you're a tech or life science business, you can go straight to our intake form at sbdctech.org/contact. We'll put all this information in the chat feature. A little housekeeping before we begin. Everyone is muted during the webinar. Tomorrow, the recorded webinar and a PDF copy of the slides will be sent to all participants. There will be Q&A at the end of the presentation, but please feel free to ask questions during the webinar by clicking on the Q&A box at the bottom of your screen. We may not get to everyone's questions, but we will do our best. If we don't get to your questions, please email hkhaled@fullerton.edu and we will attempt to answer them and get back to you. Our program today will be presented by Joe Johnston, Senior Accounting Manager at Tgg Accounting, as well as Director of Business Development for the LAOC region. During his time at Tgg, Joe has supported businesses from the startup size through middle market, growth, and transaction. While industry agnostic, some of Joe's favorite clients have included medical technology and SaaS businesses. Joe has hosted dozens of technical and managerial accounting trainings for accountants and business owners alike to help them understand the power of operational finance. Joe received his MS in accounting from San Diego State University. Joe, thank you so much for being here today. I will now turn the program over to you.
Thanks, Julie. It's always great fun being here at SBDC with the team. Always really enjoy it. Hello, everyone. Good morning / getting into the afternoon here. As Julie said, my name is Joe Johnston, and I'm a Senior Accounting Manager with Tgg Accounting. I am very excited to be here with you today to give you the third installment in our three-part series with the SBDC called Growing Your Business by the Numbers. To give you a very brief background on Tgg Accounting, we are essentially an outsourced financial and managerial accounting firm, meaning that we work to build accounting departments for small and middle market businesses so that managers, CFOs, executives have the financial information that they need to run their business by the numbers and make the right decision. Now, as a quick recap for the previous sessions that we've done, if you joined us for our operational financing course a few weeks ago, part of what we've been focusing on is how do you make better decisions on a daily basis in your business to keep more cash in your business longer and extend out longer-term profitability, whether that's by taking advantages of discounts, slow paying accounts payable, different methods of categorizing your customers, and other various operational methods that we can take on a daily basis to really help your business be self-sustaining. If you joined us last week, you may have seen our CEO, Matt Garrett, who discussed strategic ownership. In strategic ownership, we covered what is an appropriate type of business that you may want to have based on your goals, based on your legal structure, whether that's eventually wanting to go public and getting lots of shareholders, or if it's having a lot of flexibility in setting up operating agreements with your fellow members for profit and loss sharing, and really providing some great value for your fellow executives to keep them motivated. Now, in today's session, in our third session, we're going to be covering strategic financing and covering a lot of different areas of debt and general indebtedness in your business. Some of the takeaways from today is I want to help you organize your thoughts and goals on financing. We're going to discuss different forms of working capital and growth capital for your business in a very general sense. We're then going to move on and discuss a bit about government programs that exist, which Julie knows deeply about. And then we're going to end this with an 8-step process to approach business loans in a successful way. Now, before we go ahead and get started, let me just ask to the audience, feel free to answer this in the chat. who of you out there currently have debt in your business? If you wouldn't mind answering, just tell us what type of loans are you currently carrying, whether those be from the SBA, 7As, EIDLs, or personal and family loans. I'm just curious what we have out there. I'll go ahead and give you a minute to answer.
If you can put all of your information in the Q&A box as opposed to the chat box, that would be great.
Thank you.
It looks like we've got idle, PPP, and personal.
Excellent. Personal and family, lines of credit from the banks, without balances. Okay, good mix. I'm seeing a lot of government financing and some personal loans to the business. So these are great examples. And no debt yet. Standard business loans, revolver loans, credit cards. Ooh, I like that you mentioned that, because that's a good notation of where we're headed as well. Just some great feedback, team. So it seems like we have a good mix here in the audience of those of you that are currently taking advantage of loans, whether from government programs, SBA, the Fed, or commercial lending, or even more operational-based working capital financing from credit cards. So a lot of great opportunities out there. From this conversation today, whether you have financing or you don't, I want you to think about how you're using your financing to accomplish your goals in the business, and really what some of those longer-term goals look like for you with financing. Now, when we're talking about financing, having bad financing is like having a bad car purchase. At some point in time, it may have looked really great in your driveway, on your balance sheet. It felt great driving around and having this available. But after a few monthly payments, you start to think, am I really being able to use this towards my goal on a regular basis? Am I growing my business? Am I getting more stress-free as it relates to working capital use? And longer term, we want to make sure that, like a car, we're feeling successful, we're feeling comfortable, and that we have a good vehicle, debt vehicle in this case, to really help us accomplish that goal. Now, what I would like you to do is, in this moment, I'm going to pause for another second here, and I'd like you to write down 3 goals that you would have in your business if you received financing right now. I want you to think about what would you hope to finance? Would it be in efforts to grow your business, and in what capacity? Or would it be to get a little bit more stress-free and to get more operational coverage in your business? So let's get those thoughts together. I'll go ahead and give you a moment. Okay. Now, while you're getting your thoughts together, even if we're just noodling them around right now, what I want you to think about is there's a few different buckets of these goals that we're really looking at that I've already been hinting on. If one of the first things that comes to mind for you is the idea of getting more stability in your business, whether that's to say, on a regular basis, I'm struggling to line up the timing of when I'm collecting payments, when I'm making out payments to vendors, to my employees, to my contractors that I'm currently utilizing, then that's really one of our greater buckets of financing. What we want to do in this case is we're trying to get a greater comfort so that you can sleep easy, rest well, and know that from an operational level, we can continue to run the business as we'd like to without worrying about collections and continuous invoices piling up. These types of goals, when we're talking about stability, when we're talking about operational use, is short-term financing or working capital. Now, my definition of working capital and the way I would use it is working capital that you would roll on a monthly basis, hypothetically, weekly basis, to use very currently. Now, if otherwise you're like Johnny Rockets here, who's looking to grow their business, really scale up sales, maybe pump a lot of money into marketing to really get your name out there. If you're trying to increase your production capacity, to say, maybe I have one printer, one machine right now that can produce my product. And what I really want to do is I know that I have customers out there but I need the money to invest in getting more production capability so that I can sell my product. We're really going in a different direction. Or to say, maybe we're getting offered greater contracts, but we need more employees or we need more contractors that can support our effort in satisfying these contracts. Then really what we need is not the same as our stability goals. We need growth capital. Growth capital is here to increase our ability to practice our business, whether that's to produce more, to serve more clients, to really build our practice, which is very different from just an operational need. In general, when we're thinking about our financing goals in these two areas, what we want to think about is that if you have a short-term need, we typically want to satisfy short-term needs and goals with short-term financing, working capital, and we want to satisfy longer-term goals and longer-term needs with growth capital, longer-term financing. And that's what we're going to be diving into here in just a moment. To kick us off, let's take a look at a few of the different sources of working capital that most small businesses have available to them on a regular basis. We're going to talk about credit cards, lines of credit, trade credit, factoring, some of the benefits and the detriments of using these. Now, taking a look at credit cards, I'm not going to overbore you with information on credit cards. We all have, most of us will have these. Some of our business lines will already have them. But really what I want you to focus on are what are the goals of utilizing credit cards and what is the best way to get the benefit of them? And what are the areas that I'm concerned about that we need to be cautious? The goal of utilizing a credit card is, of course, to be able to pay in the future, in a future month, hopefully the next month, for something that I had to, for debt that, or a bill that I had to service today. It's great for recurring expenses, operating expenses, and the vast majority of vendors are continuously accepting credit cards as payment, whether those are your accounting firm, your IT service, your utilities, or many of the other suite of online services that your business may be receiving. They're all applicable to using credit cards. Credit cards are, of course, widely available. Vast majority of are unsecured, but in business lines, many will require a personal guarantee, meaning that when you sign your business up for a credit card, it may be the case that they ask you to take down your social security number as well to make sure that the credit debt is protected. And of course, there's a variety of benefits that are available that I've seen different businesses use. If you're a business that is significantly involved in sales and travel, you may benefit from a travel component card. But what I would default to for the vast majority of businesses is going to be a cash back card, because that is a source of instant profitability for your business. Now, let's talk about what that really looks like. It may seem minimalistic when we're talking about maybe a 1% cash back for a corporate credit card, but in truth, it can be a huge increase in your business. If we were looking at a basic business model for a company, a basic business model might be that we're going out and we're producing our inventory, we're selling our goods, and on a regular monthly basis, we're having operating expenses where we're paying for facilities, we're paying utilities, we're paying all of our service providers, whether that be administrative, accounting, IT, etc. For all of these vendors, if we were able to use our credit card with a 1% cash back, this could increase our profitability by 4% for a 40% operating expense margin business. Now think about that. That's only a 1% cash back. But if we're able to use that 1% cash back on all of our operating expenses, or even to be more conservative, slightly less of our operating expenses, all of that profit immediately goes down to your net income, all of that cash back. Because conceptually, our revenues haven't changed, our cost of sales haven't changed, our cost to produce our good, and our operating expenses haven't changed except for that decrease in the cash and our increase in the cash back. So all of that is direct to profit over the course of the year. In this case, we would get a 4% increase in profit. For some businesses, they're looking to get 5 to 7% increase year over year, and you would get 4% just by making this small change. Now, on the back side of credit cards, One of the issues, of course, is when you're accruing interest. If we're using a credit card, but we're accruing interest on it, and we're not making our payments, we're effectively paying interest on all of our operating expenses, any of the expenses that would be using the credit card and not making regular monthly payments. And similar to our cash back, all of this is going direct to our bottom line, impacting profit. In this case, with a 10% interest on a credit card and operating expenses, we would increase our OPEX by 10% from 40 to 44 and decrease it and hit that direct net income, a 40% decrease in our net income right there. Now, moving on from credit cards. Credit cards, of course, are exceptional when we're talking about paying vendors, but there's certain things that we cannot use a credit card for, right? I can't use a credit card to pay, say, my employees' wages. I only accept cash. Sorry, CEO, I'm not going to be taking your credit card information today. But there are other options available to us, such as a line of credit. So a line of credit, for those of you who aren't aware, is effectively a line is an open and available balance of cash, similar to a credit card, that you can draw from as needed for short-term financing needs in your business that require specifically cash. Vast majority of lines of credits, a line of credit can be available through most commercial lenders. These can be secured or unsecured, which means that they're not secured and unsecured, meaning that they are not necessarily collateralized by hard assets such as a home, business property, vehicle, et cetera, whatever that might be. But depending on whether or not it's secured or unsecured, could require a personal guarantee behind it. One of the benefits of having a line of credit is that it's an immediate cash parachute. If, say, for instance, we're running into an issue where, you know, I need to pay out my vendor today, but I'm really not getting collections from my customers for a week or 2 weeks from now, this is an instant cash parachute. I'm covered. I know I have security. I can pay my cash-only vendor who's not going to accept a credit card right now. And you know what? I'll draw on the line of credit and I'll get a few days of interest on it. But as soon as I get the cash back in from the customer, I can pay it down. At the same time, a line of credit can be a great tool to take care of discounts that are available to you, whether those are any opportunity that might just pop up. Sometimes if you're getting a bulk discount from a vendor, say, hey, if you take a double order, I'll give you 5% off. Well, if we're accruing interest on our line of credit, but we're getting a 5% off, with an accounting team and running through the financials, we can figure out what type of net benefit we would get from taking advantage of that discount and sending it right to profit. As we said, an example would be if we have a vendor invoice due now, but we have a customer invoice that we're not going to collect till next month, we can draw on the line to satisfy our invoice. But this effectively is similar to the credit card when we don't pay it and it's accruing interest, it's financing those expenses. So we need to be cautious of that. Separate from a credit card, vast majority of lines of credit accrue daily interest. This is a big difference. If you use a credit card to pay an expense, but as long as you pay on the statement date, you will not accrue any interest on it, and you could effectively go interest-free. If you have a line of credit, even if you draw it for 5 days to satisfy an immediate need, those 5 days are going to be drawing interest, and we'll end up having to pay that. So just be aware of this in terms of our differences. The next item that we're going to be talking about in terms of working capital is trade credit. Now, this is something that we discussed very briefly in operational financing, but it's so important, I really want to bring it up again here in strategic finance. Trade credit is effectively your credit terms with your vendors. So if you're a manufacturing business, your trade credit are effectively your payment terms with your supplier of raw materials or with your manufacturer that's sending you products that you're going to resell. If you're a service-based business, the vast majority of your expenses are going to be tied up in your people, but this will still apply to your other expenses that you're paying out for, even in operating expenses, whether that be for accounting, IT, anything that you're receiving an invoice for. We have effectively trade credit accounts payable due. Now, for accounts payable and for trade credit, one of the most wonderful things that you can see here is that interest comes in the form of early payment discounts, which some vendors will have, or in late payment penalties. Now, a lot of times you might see this in the form of an invoice that has something on it that might say 210 net 30, which means you get a 2% discount if you pay your invoice in 10 days. There's no discount if you pay it in 30 days. And if it's after that, you might be applying some interest. So these are some great opportunities you can use accounts payable to keep cash on hand longer. You can try to negotiate with your vendors to say, can I get an early payment discount? And really take advantage of some of these. As it relates to early payment discounts, if similar to the business model that we had seen earlier, if I am making roughly a 50% gross margin, meaning that to sell my widget, it costs me 50% to get the materials I need for my widget. If I can get a percentage off of that, all of that discount goes directly to my profit that I can utilize in my business. The wonderful thing about trade credit and accounts payable is, of course, as well, that it's easily planned for. With cash flow forecasting, with bill trackers, AP trackers, we can see bills coming as they're coming due and make sure that we're monitoring collections so that we can satisfy invoices. The caution, of course, is, as we were discussing, in terms of financing your payables, is when there's a very big difference between a slow paying AP, paying it on the last day possible, and not paying AP. When you're not paying your bills, you are going to run into collections issues. You are going to run into legal issues with your vendors, and hypothetically, we could have run into issues such as liens against property, being requested for personal guarantees from your vendors. And this is a huge issue, and of course, a legal issue as well. So big difference within the terms and not paying your AP. Make sure we're always paying our bills. Now, moving on to another area of working capital financing here. We're going to talk about one that can be a bit confusing and can be a bit scary. So I want to try to explain this as simply as I can. It's called factor. Now, I really like this chart I found online, but in terms of factor, one of the easiest ways to describe this, if you can think about this story, it's just that imagine that I make an invoice to my customer for $1,000, and my customer is maybe a big box retailer, or they're a big name brand company like a SpaceX or a Walmart or a Best Buy, and they say, we're the biggest, baddest guy in town, and we don't have to pay you for 90 days. Well, you know what? All throughout that 90-day period of time where I have already provided my good or service, now, during all this time, I'm still going to have expenses. I'm still going to have to pay rent, pay utilities, pay my people, or start working on new orders, all this upfront cost without having any money. So what factoring does is factoring says, hey, I have these receivables that are due back to me, but I need cash right now. So what I'm going to do is we sell this receivable to what's called a factor. And the factor is an institution that is going to give me an advance on the receivable. So for that $1,000, the factor may give me an advance of 70% to 90%. Maybe they'll give me $700 at an interest rate of 1 to 5% on it. And I'll get that immediately so I can use it for operational purposes. And when the customer eventually pays, what the factor is going to do is they'll give me the rest of the funds less the interest coverage. So this is a way to get cash right now in your business when you need it, but you're going to take that haircut of the interest on your revenue and on your receivables, which can be sizable. So I hope that's a good description. Moving on from this, as we said, it's very typical. This is very typically used when your customers demand really long terms because they have economies of scale. They're really large name companies. AR factoring is widely available when your business is profitable, because there's obviously a lot of revenue to be made on the other side, making these short-term loans. AR factoring is typically unsecured because it's effectively secured by the receivable that the factor is going to be checking to make sure that you have good terms. in general, the level of advance that you get, the interest rate that you get, is going to depend on the speed of your collections on a regular basis, as well as your collectability and the collectability from that customer. That's not to say that if you have a customer that you have a receivable from and they're refusing to pay you, that you can sell it. You cannot do that because no one is going to buy your bad debt. But if you have recurring sales to customers that we need cash from, we can utilize factoring. Now, the benefit, of course, as we said, is that you get cash right now. It's an immediate satisfaction. If we have an emergency, if we need to cover an operational need, get cash right now. But the detriment of using factoring is that it's a continuous drain on profit on a percentage of your revenue. So for instance, in this case, I tried to use a very middle of the road example. If we were using AR factoring on all of our revenues and all of our sales, and we were getting 80% advance, or 80% of our sales advanced at a 3% interest rate, that would be a 2.4% haircut direct out of revenues. But let's think about this again. Our cost of providing the service does not change. Our COGS is still the same. Our operating expenses do not change. They are still the same. And when we get all the way down to net income, now instead of making a 10% net income, I'm making 7.6% net income. I've just chopped my profits down by 24% by this small figure. So there's a very serious longer term concern as it relates to AR factoring that you need to be aware of as you're making these decisions. Now, this has covered quite a bit of some of the items that are available out there for you in terms of working capital. There are more out there, of course, but these are some very common ones that you may hear out in the marketplace that may be offered to you or for your business. So just things to keep in mind as we're working along. Now, for those of you that had put together goals on your sheet there that were really talking about, I want to grow my business, I want to scale my business, I want to increase capacity, and I'm going to knock Coca-Cola off the top. They've been there too long. This is our section of the slides. We're going to talk about this, which is growth capital and term loans. So when we're talking about growth capital, there's a few different buckets here. Of course, we're talking about, in some degrees, we're talking about increasing capacity, right? So this may be getting bigger facilities and getting mortgage loans, which are real estate-backed loans, or it could be getting hard fixed asset-based lending, if that's for, or not necessarily fixed asset-based lending, but lending for fixed assets and fixed asset development, which is going to increase our production capacity. On the other side, of course, we have government programs that are available. There's quite a bit of term loans available, and our general commercially available term loans. So let's dive into this a bit. In mortgages, mortgages are wonderful. They're real estate backed. The SBA has some that are available, including the 504 loan that could be used for real estate, as well as for heavy industry. But some of the key facts about this, of course, is that the loans are secured by physical property. Equipment loans are typically also secured by the equipment itself that you are financing and purchasing. The loans can extend for as long as the purchase of the property. I believe the SBA's 504 is for 20 years, but equipment loans could be scheduled for any length of time, depending on the payback period from the commercial lender. Now, these are great when we're using them to either purchase first-time property. Maybe we're trying to get a storefront. Maybe we're working on improvements to our existing building, or expanding production, of course. Now, some of the benefits of these loans are, of course, that you wouldn't go out to buy a house with a credit card, right? Because we're not going to pay it off next month, and we're not going to pay it off at 14%. But you would want to buy a house with a longer term loan because we're going to have great long terms for 20 years, 30 years, so we can slow pay this into manageable amounts. If we have real estate-based loans, if we sell the property, we can refinance the purchase to sell our loan and sell the property if needed. And really, throughout the course of most of these loans, we're going to have the ability to refinance. as the economy is changing, as our creditworthiness is changing, we can reapproach refinancing for our business. In terms of real estate-based loans, mortgages, of course, a hurdle to get over is having a mortgage deposit on the property so that we can get some skin in the game, so to say. And of course, for some of them, we're going to be facing either variable or fixed interest amounts. So when you're looking at loans, whether they're mortgage or equipment-based loans, just as for many of these loans, we want to make sure that we're shopping and that we're understanding what's available out there for us in terms of our terms, our interest rate, our payback period, whether it's fixed or variable, and where your position is as a creditor in the market to apply for these. Now, moving on to our next stage here, of course, is government loans. Now, the SBA provides a huge amount of information on this, so I'm going to touch some of the SBA materials peripherally, but we're going to go deeper into the few of the other areas that you may not be well aware of as well. Through government programs, of course, the SBA has available the PPP loans. We have SBA 7As and 504 loans, which are great for small businesses to get started for working capital as the SBA defines it, for 5 to 7 year loans, or for longer term loans to invest in things such as equipment and real estate and marketing for your business. Other options that have come available through the SBA, of course, are the economic injury disaster loan. The EIDL, as it's called, of course, was utilized even at the time of Hurricane Katrina to help small businesses that were impacted by federally declared disaster areas where small businesses needed these funds to recover. Now, of course, during all of this time with coronavirus sweeping the nation, so many business owners were impacted, whether at the sole proprietor, independent contractor, and really just small business level, that the EIDL became available nationally. For a short period of time, a few months ago, the EIDL was only available to agriculture for a short time, but it has recently been reopened for all businesses up to a max amount of $150,000 per business, which is constantly changing, by the way. If you're watching this video 6 months from now, I'm sure it's probably not current anymore. But through the SBA, other sources of financing are of course available, which are SBA 504s, SBA 7As, payroll protection loans, and the EIDL. Now, some of the wonderful things, of course, that the SBA does and has available is that these loans, since so many of them are either completely or partially government guaranteed, will offer you lower interest rates than you might have available to you out in the commercial market, and will also be able to alleviate you from some level of the personal guarantee. Now, having this available is wonderful because typical commercial lenders won't be able to offer you these same rates for non-SBA loans because they're going to be holding a certain component of the risk. So SBA loans have a wonderful benefit out in the market. And when we're talking about long-term financing and growth, SBA can be a tremendous tool. Now that we've gotten through some of the SBA material, I wanted to touch on something that goes a little bit outside of the SBA side, but still within our federal government loans that are available. Now, some of you may have heard of these. They are called the Main Street New Loan Facility, MSNLF, which has been approved and now will be getting provided via the Federal Reserve System. Now, the Main Street loan is designed to be another supplemental loan for businesses that are in operations that are still struggling due to impacts from COVID-19. But some of the wonderful things about these loans that's unique about them is that these loans have now been reduced to a minimum size of $250,000 per borrower, with interest and principal payments that can be deferred up to 2 years from the loan origination date on a 5-year loan. So really what you end up with is interest and principal payments that will be 0 for the first 2 years, 15% for the 2 years after that, and then a balloon payment at the end. So the Main Street loan can be a good opportunity for some businesses. If you are a business that is in operations, that you satisfy some of the minimum requirements of having EBITDA, which effectively means your income with adding back taxes, depreciation, and amortization for 2019. As long as you earned $62,500 last year in these amounts, then you're a great contender for the MSNLF. So I'd highly recommend this to be something that you look into. And again, as a reminder, the Main Street loan is outside of the SBA, so it's another government loan opportunity that's available. So now that we've covered a few very specialty type of loans, we've dove into working capital loans, very specific. We've dove into equipment loans, real estate loans, some of these government loans. I'm going to broad brush one subject here, which is your general term loans. And general term loans are widely commercially available through almost any lender out in the market. Any typical commercial bank, whether it's Wells Fargo, Chase, I think it's Farmers and Merchants Bank, any bank out there is really going to have a term loan that could be 10, 15, 20, 30 years at a pretty standardized interest rate. And the best thing I'd say is that these are going to come in all shapes and flavors. If you are interested, if you find out that an SBA loan may not be appropriate for you, MSNLF may not be appropriate for you, and we're looking at other sources of financing, the best advice that I can give is for general term loans, shop everywhere. You are going to find that there are different terms. Some will require different interest rates. Some will require more documentation from you, personal guarantees, different sources of securitization. And really what you want to find is the perfect one out there for you. It never hurts you to shop, right? Just like finding the best price for the same car, you could go to 10 different dealerships and find 10 different rates. You could do the same thing with a bank loan. So be sure that you're out there shopping for different loans. Now, team, to wrap this all up, now that we've covered so much on our loans, we're going to run through our 8-step process just to make sure that you're planning for success as it relates to debt, whether it's in your current business that you're holding debt, whether you're planning on not having debt. This plan is really going to be successful for you to just get your thoughts together and get everything on the right track. Now, the first step when we're talking about making a decision about financing, is setting your goals. Think about where we started and saying, what do I want to accomplish with financing? Am I just stressed right now and I need operational financing to get through on a regular basis because my growth is already happening? Or am I really trying to find another source of funds so that I can grow marketing, grow sales, grow capacity for more manufacturing, get new facility? Think about all your goals and put those together. Top 3 answers that you want for yourself. The next step is take those goals and go consult with your advisors. Speak with the SBDC. Speak with us at Tgg Accounting. Where together we're all working and speaking with bankers on a regular basis so that we can start to divide you into different directions, saying, based on your goals, this is a general type of loan that I think is the most appropriate for you to start with. And that way we can really start to piece things together. With that general direction, the next step is putting together your financial plan. Let's figure out, okay, if my goal is to get that equipment so I can increase production capacity, and you know what, I spoke to my advisors and they told me I should get this type of loan, equipment-based financing, let's figure out how much we would really need. How much do I need to borrow? What do I think is an interest rate and a payment that I could actually manage? How much is this equipment going to increase my production capacity? All of these financial questions should be part of our financial plan and our scenario analysis that we'll do related to taking on the new debt and feeling comfortable with it. With that financial plan, you want to develop and forecast cash flows. One of the most common tools that we utilize, and we recommend everyone utilize, whether with us or without, is a 13-week cash flow forecast. 13 weeks being a financial quarter. With 13 weeks, You can look at what are the bills that are coming due, what are my loan payments that are coming due, what are the credit card payments that are landing, and really start to do some scenario analysis to say, if I got that loan today, how would I be able to make payments week over week or month over month, and what would this really look like? With that financial plan, you can feel that much more comfortable in your business that you're running it by the numbers. With all of your information together and your cash flow projections, now you can start to search and shop for the appropriate financing. Speak to the SBA, figure out what your loans would be. If we're looking for a non-SBA loan, let's start shopping with different bankers, speak to different advisors, and figure out what are the different terms I can get, what are the different rates I can get, what opportunities are available, and select the best one for you. It's not all about interest rate. It's about holistic terms and covenants. When you have your right loan, go ready and apply. Let's go out there and engage. Let's get it locked in and let's secure our debt. And after we have it, the next step is not just over. Just like having a car and having good maintenance on it, we need to constantly review our financial information, constantly review our cash flow to make sure we can service debt appropriately, that we're making operational financial decisions to manage AP and manage cash flows, and make sure that we're managing debt appropriately. That way, if we need to have a conversation throughout the course of utilizing our debt to say, hey, my customers are really troubled because of COVID-19, I need an interest rate deferral or a payment deferral, we have all the financial information in the backing to have that conversation, be proactive and really right on the front end with bankers. Because if there's anything that a banker appreciates, it's being forthright and having goal congruence, meaning that they always believe that you're telling them the truth as it relates to your business and your loan. When you follow these steps, you will thrive, you will have more comfort in your debt, and you'll have more comfort that your debt is working to accomplish your goals for you. Now, team, with all this in mind, of course, there's a huge amount of resources out there as it relates to learning about debt financing. It's something that we work through with business owners on a regular basis, especially now. If you're looking for additional resources, we'd love to contact you and set up some consultation time and just chat with you about your business. And of course, the resources are here and available at the SBDC as well. So please feel free to reach out to us. And with that, I'm ready to take on any questions.
Our first question is, where do we go to find out more or apply for the MSNLF loans?
So that's a great question. So the Main Street, it's such a long name. It's the Main Street New Loan Facility. One of the great places that you can find more information about it is to go to your Treasury website. They do have general term sheets online. What you should know about the Main Street loan is that in our communication with lenders as of right now, the Main Street loans are about to become available through vast majority of commercial lenders that have agreed to it. They've been consistently tweaking terms to figure out what do we want to make the minimum balance, minimum loan amounts, minimum interest rates. So what I would say is a great source is, of course, going to be the Treasury website. And if you'd like to get added to our newsletter, send us an email at info@tgg-accounting.com, and we can send you out information as it becomes available.
I don't know if you feel comfortable answering this, but I'm just going to ask it anyway, and you can just say no if you don't want to. But it says, can you go over what the EIDL can be used for?
That's a great question. I think that as it relates to use of the EIDL, I know it has many operational uses. You can also use it for payroll, but it may impact your ability to use the PPP. What I would do is I would recommend filtering that question definitely through Julie and the SBDC team, or send me a direct email and we can do a little bit more direct research for you.
Those are the questions.
Excellent. Well, team, if any questions pop up as it relates to operational financing, or you just want to review the opportunities for debt, of course, always feel free to reach out to us via email, and we'd be happy to assist. And Hannah can pass along any information as well.
We have another question. Any thoughts on convertible security instruments, debt that could turn into equity?
So you're talking about utilizing these for your business for officers?
Andrew, if you could clarify in the question box.
As it relates to the convertible security instruments, it can be a tool. I'll just say kind of in the most general sense, a convertible security instrument, if we're talking about using this internally for officers and members of our business, it can be a good opportunity to say, hey, you know what, I'm going to lend. I want one of my officers to make a loan to the business for $100,000 that if it's not paid back within a certain period of time, we could convert it into equity. It's certainly a good opportunity, but with whatever this financing decision is, whether it's a convertible security for your own business, one of the best things that I could say about it is that, first of all, we need to make sure that we have a strong financial plan so that we can understand what our ability is to pay the debt, of course, and service the debt. And the second is, as it relates to a convertible security, if this is something that's going to put someone at risk of taking ownership position in your business, just make sure that's something that, of course, you're willing to do if the debt doesn't quite pan out, of course.
What conditions are needed to make the idle forgivable? Oh, you know, we're going to skip that. We're going to go to
see.
What are debt financing options for heavy manufacturing equipments, like 1 million production machines?
Oh, that's a great question. Yeah, there's a lot of opportunity out there as it relates to equipment financing. So there's a few different ways to go about it, and the best thing we want to do is shop with different bankers understanding our terms. But we could either get hard asset-based financing, which is one option, to say that effectively I am getting a loan and I am telling the banker that I am getting this loan for the purpose of getting this equipment, and I'm going to pay it back over a certain period of time, but the loan is secured by the equipment. And that happens very often. A second way to go is, of course, to get a general term loan for the business, might be otherwise secured, and using that to finance the equipment instrument. So there are a few different options out there for you, and I would just say that the best goal is, of course, to understand your financial position, shop for the various different loans on the hard asset-based financing side, of course, on the term loan-based financing side, and let's figure out we want to coincide the growth of the business with the payout of the debt. So to say, if we're buying this heavy equipment to increase our production capacity and sell more product, we want to make sure that, maybe we're managing our payments so that these are going to increase as sales are increasing for an overall financial safety. So I hope that helps. Okay.
I was on mute, sorry. Is it best if real estate loan is separate from the business?
It's an interesting question. I would say that real estate loan separate from the business. I would personally probably maintain it in the business, but you have to look at your specific financials in that regard and figure out what is going to be guaranteed, what is the level of security, whether you're going to have commercial property secured by yourself personally or secured in another method by the business. So we have to take all of the terms into consideration when we're looking at the real estate loans.
I'm looking for a line of credit. I was told that most banks right now that have SBA loans are not offering them because everything that's going through with PPP. Do you have any suggestions?
In terms of lines of credit, we are seeing some that are still available. I'd say a good starting point is, of course, with your existing commercial banker, which I imagine that you've already done. The next step after that, of course, there's a lot of banking resources out there, but I'd love for you to reach out to me individually. We can figure out if we can connect you with a good lender. But lines of credits will continue to be available. I think what you're experiencing right now is that banks were effectively over-encumbered by the processing of PPPs, since those, while they are through the SBA, they're through SBA accredited lenders, your banks. So they may be over-encumbered with those and may be deciding to take on less lines of credit for your business. But if you go in shopping for a line of credit or really shopping for any loan, one of the best positions and strongest positions you can take is to have your financials available, have your business, have that good understanding of your business where it is, so you can be forthright with the banker. They'll understand that you are, of course, able to service the line of credit and how much you need and for what operational purpose you're planning on using it on a regular basis. When we have goal congruence and communication with our banker, we're going to get the best results.
I'm looking to expand and need a loan to do that. There will be an opportunity to buy the building at the end of the year. Do I get one loan for each?
Interested in expanding our existing facility and need a loan to do that, and then we would be looking to buy the building at the end of the year. What I would say is not necessarily. Loans are so dynamic that in one sense you could start with your expansion loan right now, and when we get to the end of the year, what we may do is we may be able to speak with our lender, speak with another lender to say, hey, I really want to purchase this building because that makes financial sense for me right now, and as a component of that, I'd like to also refinance this other source of debt. So it's I would say it's certainly possible to consolidate debt in the same way that you would consolidate credit cards. It's very possible. So I would say you could start out with what you're looking for right now and what makes the most sense. And maybe what would be the best approach is to just communicate that possible future intent with the banker that you're getting the loan with immediately.
All right, those are all the questions I have.
Tremendous. Okay, team. If any other questions pop up, of course, always feel to reach out to us. Reach out to Hannah, and I'm sure she'll pass out information as well. You can reach me at info@tgg-accounting.com.
Great, thanks so much, Joe. We really appreciate all of your support, and thanks to TGG for this fabulous three-part series. Thanks to everyone for joining us today, and we'll see you at our next webinar. Thanks again.
Take care, team.